Welcome everybody on the webinar. Today we're going to talk about theory and practice and the changes to OMB single audit guidance and guide implementation. Welcome once again to the training. Just some brief introductions. My name is Krouse. I'm a partner on the not-for-profit service team. Also you'll be hearing from today Mark DeVries, who's a Director of Government Services in our Wisconsin office. Briefly, just a little bit about Sikich for those not familiar with our firm. Our firm was founded in 1982. We were one of the top 35 largest, right now we're one of the top 35 largest firms in the country. And today, unique experiences, you'll hear a couple perspectives. One coming from the two of our industry service teams. I mentioned come from the non-for-profit service team. In addition, Mark will be talking more in the government services team as well. Just some learning objectives today. Once again, also that this is eligible for CPE. Those are obviously looking for the CPE hours. This is Yellow Book, also eligible. You will have to complete the survey at the end of the presentation to be able to obtain your CPE hours, but it is 2 hours of CPE. Some of our learning objectives we're going to have. Really it's about, what are the changes to single audit guidance that will affect your organization, and also learn what you could do to help implement the new guidance. Of course, the main goal is to avoid some of those audit findings that maybe have been an issue in the past with the organization. We'll go back real quick on some of the little history of the single audit. Really the single audit first was enacted back in 1984. The first single audit, before 1984, really all the federal agencies required their own audits to be done separately. And really this was more of a standardized practice, so all states, local governments, and even Indian tribes would be under the same set of rules, basically. OMB issued A128, audits of state local governments later, and then really nothing really changed again to 1990. 1990 really extended the single audit requirements to include now not-for-profit agencies. They became part of OMB A133, which superseded the previous guidance in A128. 1996 saw the next really single audit act revised, and really the next one, it's not in the slide, but the next one really is 2003, when really the creation of the cap on the amount of requirements for single audit went from $300,000 to $500,000. And of course, in 2013, what we're going to discuss today, really the uniform single audit guidance that really superseded the 8 previous OMB circulars. The uniform guidance, really, this was originally drafted by the Council of Financial Assistance Reform, COFAR as it's known as, and it really combines the eight circulars previously set in one comprehensive document, which of course would be the A21, A87, A89, 102, 110, 122, and 133. Really brought in guidance, so everybody's under the same guidance, and that's really the A21 was followed by the educational institutions. And of course, A87 was followed by state and local governments, and A122 by not-for-profits. What this does is really the cost principles are a common rule. Audit requirements are included in this guidance as well. What its goal was, of course, to eliminate some conflicting and overlapping guidance. Oftentimes there was guidance in one circular that was contradicted itself in a different circular, so it really just improves that overlappiness. It really results, the goal is obviously to result in more consistency by having a uniform guidance. That's what it's called, uniform guidance, having that consistency and efficiency. And really, of course, other goals, of course, is focus more on performance. The compliance aspect of it is, what the auditors focus in a lot, and it's really, they decided it didn't make a lot of sense to have as much compliance-driven information as it does really performance. That's really what they're trying to achieve, and really improving the integrity of financial management. Some of the uniform guidance is going to happen, of course, as mentioned, is we'll talk about later in the presentation about some of the changes in the single audit itself, but it's going to reduce the burden for many agencies that are really under the single audit guidance. When the threshold gets raised to $750,000 for years ending on or after December 31st of 15, it's going to really reduce the number of single audits by about 5,000 single audits. But the coverage that the federal government will achieve will still be about 99%. What's kind of interesting, the fact that the single audit, when it changed from 300,000 to 500,000. It also eliminated about 5,000 entities. So this new change from 500 to 750 will probably eliminate another 5,000. So we put the number of single audits out there nationwide into the low 30,000s for the first time. As a general rule for application, really, the focus we're going to really be talking about today is really found in Part 200. Part 200 really is the focus on, it brings in the administrative requirements we'll talk about first. Then we'll focus in on the cost principles themselves. And finally, end of our presentation today, we'll talk about audit requirements. Keep in mind, this is a 2-hour webinar, so we're not going to be able to cover everything in the uniform guidance. It's at least 3 inches thick if you printed it all out. We're going to try to highlight some of the things that we feel are the important things that we feel that most organizations will want to focus on. So we kind of try to take the best of what we feel is in the uniform guidance and some of the things that we want to present today. As a general rule, federal agencies, these apply to any federal agencies that makes federal awards. So if you're a federal agency that's making federal awards, you would be applicable to. And of course, most of the audience we're talking to today is really non-federal entities, the states, the local governments, Indian tribes, higher education, not-for-profits, all those organizations that go out and carry out a mission or a program as a recipient, or they could be a subrecipient. We will be talking today about what's applicable for subrecipients as well as past organizations. Sections 200, 101, it gives you some exceptions to the rule. There's some organizations that may not apply to, as I noted right above. There's certain circumstances we're seeing now that some of these rules apply to for-profit entities. There's a lot of for-profit entities that carry out federal awards now, but these rules will apply to them as well. As far as the implementation date for this guidance, really effective immediately, but really for recipients of federal funds initiated by the federal government after December 26, 2014. So effectively January 1st of 2015. So one thing that we'll point out today, and you'll note that there are going to be circumstances this next year where you may have some grants subject to the new uniform rules and others that were initiated prior to 1/1/15 that could be under the old rules. So there's going to be definitely, you have to understand, make sure one of our implementation tips is identify which grants are subject to the new guidance versus which ones are still subject to the former guidance found in the older circulars. Some other useful information that we find is using the uniform guidance on the OMB website. There's really good items there to do. There's really good crosswalks. That's what we like to see with the guidance. Is a lot of times people want to know what changed, what are the areas of change. What you can do is go to the website we highlight there and note that. You can very well see the cost principles, what changed as far as the cost principles goes. As you see, 174 pages just comparing the old text and the new text on what changed versus the cost principles. Another 46 pages just specifically on audit requirements, and then finally another 123 pages on the administrative requirements, which we're actually going to talk about first in today's discussion. We'll be happy to help what we can do to help you implement these requirements. There'll be contact information we'll give to you at the end of our presentation. And also this presentation, just so you know, and all the materials will be available at our website under the address you see right there. Okay, now to get into the administrative requirements themselves, the first one we're going to talk about is on conflict of interest. It's found in section 200.112, and it requires really the non-federal entities to disclose potential conflicts of interest. Nothing really new with the fact that there's always been really those provisions in there, but there's been a much greater emphasis on these provisions in this new uniform guidance than probably ever before in all the other circulars. And one of the things they're talking about is making sure that disclosure is in writing of any potential conflicts of interest. We want to make sure that it talks about the implementation tip that the conflict of interest needs to track those conflicts and remind your board staff that they have to inform management of any potential conflict of interest. The key point there is it has to be both in fact and appearance. oftentimes the facts say that maybe there not be a conflict there, but in appearance it may very well be a potential conflict that needs to be disclosed. So the key point is making sure you understand that even in the appearance, if there's a conflict, those items have to be disclosed. Program managers need to be aware of the contracts they enter into under the program. Keep in mind that whoever's administering the program, those key program managers have to be aware where there could be potential conflicts of interest. And then finally, underneath that is, although it's not required, those relationships, even when there's determined eligibility in program applicants, need to be disclosed as well. I'll give you a couple good examples there. Oftentimes in higher education, a student financial aid director, they could be approved in student financial aid for a relative. And it's based on some subjective and factors that you want to be sure that if there are conflicts, that those are disclosed. Another example would be some kind of an intake specialist that's approving a potential relative of theirs for any grant-based need based on some certain eligibility criteria. So those are types of things that need to be disclosed in writing. Some other mandatory disclosures, as far as non-federal entities that they have to disclose in writing, whether or not there's any violations with federal criminal law, including, of course, fraud or bribery. And it really doesn't mention in the materials whether it's a material fraud. It's really any fraud that's being reported. That needs to be a mandatory disclosure, and that's found in Section 200.113. It's really more like the requiring more self-reporting of any of the fraud or criminal type activities. The next section we're going to go through is really just talking about performance measurement. I mentioned earlier part of the goals for the new uniform guidance was to improve efficiencies in carrying out the federal programs. In the past, everybody assumes that if the cost comes under the budget, that the program is being operated efficiently. But sometimes what's missing is the program achieving its goals, and I think that's really where performance measurement comes into play a lot. So what the Section 201 mentions is there's going to be situations where payments will be specific on specific requirements, not necessarily just tied into the cost that they incurred. And really what that's showing is there's going to be less emphasis on costs and more interested in achieving the results. So really looking for results is where you can see some of these grants. And so it's going to require the recipients to relate financial data to how much performance is accomplished. You'll hear this term used where milestones are achieved. Really, is the recipient of the award, are they communicating those milestones? And as an implementation tip, of course, consider building some of these performance and costing processes into your financial system. So making sure that you can capture those results when you'll be able to do your performance. A lot of times grants themselves, when you're doing closeout reports, you do have to include performance. There's a lot of times there's non-financial data that goes into the closeout reports of certain grants. So being able to having a good system to be able to capture those is very important. We heard a terminology earlier. I mentioned whether or not you're a subrecipient or a pass-through entity. You'll hear that in a few other areas as well. But in Section 220.330, we talk about really comparison between what a contractor is and really what a subrecipient is. A subrecipient is required to list on federal expenditures on the SEPA. Really what distinguishes a subrecipient versus a contractor is in a subrecipient circumstance, they're the ones who determine the eligibility, who's going to receive the federal assistance. They're the ones that have to measure their performance against certain objectives, as I mentioned, oftentimes performance objectives. They're the ones making the program decisions on who gets the aid, how's the aid administered. They have the responsibility to adhere to their compliance requirements. Each time they receive a grant, they have to be able to understand that grant and know what the compliance requirements are to be able to make sure they adhere to those requirements. And finally, they use the federal funds. They have to carry out the program themselves. They're the ones that are judged on how well the program is carried out to be able to provide those goods or services. Contractor, in contrast, I guess, a contractor, they provide goods and services, but theirs are really within the normal course of business operation. It's what they do. They may provide similar goods and services within normal business operations. They typically operate in competitive environments. It's a little bit different than a not-for-profit that's really not necessarily in a competitive environment. And really, their goods or services are really ancillary to the operation. It's not necessarily part of the operation. It's really just ancillary to it. And finally, they're not subject to the compliance requirements of the federal program. To give you an example where you'd see a contract relationship versus a subrecipient is an example of if a grantor purchases vehicles and they use federal funds to purchase vehicles from an auto dealer, and the auto dealer operates really in a competitive environment. This is really a transaction that's not necessarily it's not a subrecipient relationship. It's really in the normal course of their business, the contractor is providing those goods and services. So that would be subject to the rules we're mentioning. As far as pass-through entities go, of course, if you're ones passing the grants through to a subrecipient, you have a lot of communication that you have to incorporate in your subrecipient agreements or your communication with the subrecipients. You need to have controls in place that ensure that you're really communicating information to all of your subrecipients. What's some of the information that's needed, of course? You need to have the recipient's name. Of course, that has to match what's in the DUNS system. Making sure that they have a DUNS number is important as well. And then the unique federal award identification number. That's something relatively new that came out, I believe, in 2013. It's really it's a unique number to each federal award. So that's strictly communicated. The reason for that, it's really intended to have that enhanced data quality. So then the public can monitor, track specific government awards and how the spending is going on those specific awards. And that's done through that FAME number that it's newer to the grant you're starting to see now. It has to have a federal award date, of course, when the federal awards will be applicable for. Keep in mind those federal award dates oftentimes don't match the fiscal year ends of your entities that receive the funds. Oftentimes a June 30 year end or a fiscal year June 30 year end may receive a grant that runs on a calendar year. So making sure that federal award date is communicated is important. As far as saying the period of performance of the grant, including when does the grant start and end. Oftentimes grants are multi-year grants. As I mentioned earlier, sometimes they are not necessarily the same period as the fiscal year. Other information contained in the federal award that they have to include that comes from the pass-through, obviously the amount of federal funds obligated and awarded. If there's a budget that needs to be followed, that has to be approved by the federal award agency. If there's approved cost share or matching, oftentimes there's matching involved, where an entity must also raise their own funds that are non-federal funds that are used as part of the match, and those funds have to be used as well. Oftentimes, also need to know the name of the federal awarding agency, whether it's U.S. Department of Health and Human Services, Department of Housing and Urban Development. Any of the federal agencies need to include what federal agency the funds are coming from. The CFDA number, the Catalog of Federal Domestic Assistance number, is a unique number. It's a 5-digit number, of course, with the first 2 digits referring to the federal agency themselves. For example, 84 would be Department of Education, or 93 Department of Human Services. Those type of things have to be included, and also the name of the federal grant. If you ever not see any, maybe you see the number but you don't have the name right, or you know the name but you're not sure of the number, a good website to check out would be the www.cfda.gov, and you can type in the number, the CFDA number, and it should come up with the proper, I guess, the proper true name of the federal grant would come up there. You'd be able to determine for sure what that is. You have to include whether or not the federal award is research and development. If you don't typically work with those type of grants, it's not usually an issue, but you do have to identify whether or not it's an R&D. That's also a question for those who are responsible in filing the annual data collection form through the Federal Audit Clearinghouse. There's a box to check for that as well, so that's kind of where that's coming from. If there is an indirect cost rate, you do have to note what that rate is, if it's applicable, or oftentimes if it's just a de minimis rate of 10%, have to include that as well. And then finally, the general terms and conditions of the grant. whether specific things. That's what a lot of times you'll see a lot of the compliance or allowability of costs, things like that would fall into the general terms of that grant. And one of the things I'll mention too is if you're, I'm talking as if we're going through the pass-through entity, their responsibilities, but if you're a subrecipient and you feel you're not being communicated all this information, I think it would be in your best interest to reach out to the pass-through and ask them that I am not receiving all this information. Could you provide this to me? Because even though the pass-through organization has certain responsibilities, as the auditors are doing the audits for the subrecipients, they may have issues with not seeing certain information included in the grants, and I think it would be in your best interest as a subrecipient to reach out and note what you may be missing from the award that you've been given by the pass-through. Other things to note too, that really the subrecipients need to ensure that the awards are identified and mentioned by subrecipient, making sure that the proper CFA number is the proper amount term. They would need to make sure that they communicate all the federal requirements to the subrecipients. As I mentioned, anything that's allowable, not allowable. Any additional requirements, oftentimes there's additional reporting that has to be done. Those have to be clearly communicated to the subrecipient. Once again, communicating if there's that federal, if they have a federally recognized indirect cost rate, that's communicated. And really, the subrecipient always has to be able to allow access to the records. So a pass-through entity can request from the subrecipient to examine records. They could request, and we'll talk about this in a minute, but they could request things like an agreed-upon procedures engagement. If there's issues with the subrecipient, the pass-through entity does have the rights and the duty to look into the subrecipient and do their proper monitoring. Which is the next subject on subrecipient monitoring. As mentioned, to monitor a subrecipient, you have to be sure that the award is being used for its authorized purpose. Because keep in mind, when you're doing the monitoring, you're monitoring for both program results and financial results both. So you have two responsibilities, not just to be sure that the dollars are spent, that they're being spent and the actual program is being carried out in its intended way. So that monitoring does often result in requiring really different groups of people to do the monitoring within your organization. Obviously, you want your financial people to monitor the financial results of the subrecipient, but you often have to involve your program-related people to go out and visit these subrecipients to be sure that the programs that are being carried out in a proper way. They're required to obviously review those financial and programmatic reports, as I just mentioned. They're required to follow up on deficiencies. If the pass-through organization sees deficiencies in the prior years for the subrecipients, they do have to follow up with those to be sure that they're being carried out. Because keep in mind, when they're looking at the subrecipient's audit findings, it could impact the pass-through agency's findings and or their financial statements. For example, if a subrecipient has an issue in their single audit and there's maybe a qualified opinion or noncompliance that's material to the financial statements of the subrecipient, that could affect the financial statements of the pass-through entity as well, because they may need to be returning funds to the federal government. In other words, they would have to request funds back from the pass-through organization, or sorry, the subrecipient, and then themselves would have to return funds to the ultimate federal awarding agency. So there is a lot of implications whether or not there are findings present in the single audits of the subrecipients. They are required to verify that an audit is conducted themselves. Oftentimes a pass-through organization may only send $100,000 to an organization, but that subrecipient has funding sources from other funders, and they could have over $500,000, which would trigger the single audit. They need to verify that that's being conducted, because they may not have given $500,000, and so they wouldn't necessarily have a single audit, but they do need to inquire whether or not that organization has received funds from various other funders that would put them above that single audit threshold. And then, of course, the other item to do is consider whether or not that there's agreed upon procedures that may be necessary. There's often times where a past organization, in fact, our firm has done this in circumstances where we were hired by our past due organization to go do some agreed upon procedures on subrecipients where we're actually doing looking for things that they feel are not being properly. Maybe it's an issue with allowable costs, and they're concerned that they are spending money on areas that are not proper, or they're not doing their payroll correctly, or allocation of payroll, things like that that you could specifically look at and determine whether or not that subrecipient needs to have that followed. And that's oftentimes necessary where you have a subrecipient that may be falling under the single audit threshold, so they're not really having another outside audit firm going in and looking at specific compliance. So those smaller entities oftentimes could be subject to the consideration of whether or not to have an agreed upon procedure engagement because of that monitoring by an outside CPA firm not being present when they're under the threshold. But one of the tips, of course, is to establish a process for monitoring, making sure that they have a calendar to track the monitoring requirements, make sure that process they're tracking throughout the year. Things that I often recommend too is a lot of times we understand that the past due entities, they may have 50, 100, however many subrecipients, and it's just not really economically feasible for them to be able to go out and visit all the subrecipients every single year. So they need to have at least a schedule in place where they are doing routine visits, whether it's every year, every other year, and then also doing the same thing on the program side, making sure that they're doing their program monitoring. Of course, they should be requesting financial statements every year from the subrecipients, and certain things would have to be done every year, but possibly making some of these site visits just isn't practical to go out to every single organization every year. But as long as you have a plan in place and you're following your plan to properly monitor the subrecipients. The next section we'll talk about is on their financial management. That falls under section 200-302. What we did on the slide, you could see where there's been some changes. What we tried to do is highlight those. They should be in the italics. Really, the financial management system, grant awards, it's really what has to be able to do. You have to be able to, the entities are required, they have to be able to tell the outside auditors what their federal awards are by CFPA number, by federal award ID number. I mentioned that identification number by federal award, and also name of the federal agency, or if they're a subrecipient, who the pass-through organization is. That's really, their financial system has to be able to do that, be able to track their own federal awards. They have to also, this is not new, but they have to be able to provide the financial results for each federal award. They have to be identified what the source applications of the funds are. They have to have the effective internal control. We'll talk about internal control in a minute or two. Really, they have to have effective internal controls in place on any assets they acquire with the federal funds. Oftentimes, there has to be a comparison of expenditure and budget. Typically, when a subrecipient or a pass-through submits a budget to receive federal funds, they have to be able to be accountable to how they spent and according to that budget. And finally, one thing I did highlight, I even underscored, they need to have written procedures on how they determine allowable costs. That's a very important thing that falls under financial management. They need to have procedures in place so that everybody within the organization that's involved in the programs should be able to determine or understand what costs are determined to be allowable. And really, your chart of, the important tip here is your chart of accounts need to be able to accommodate the required information. In other words, whatever reporting you have to be able to do to the federal government based on to show how you spent your awards, your chart of accounts should match that. Your chart of accounts should be designed that you'll be able to produce that financial information, that you can identify that financial information to any outside parties, including the auditors, but also including the federal agencies. If they were ever to do their own monitoring, you have to be able to show how you track your financial results of your federal funds. You need to have your system, and a lot of that too is designing your internal controls that they can determine whether or not any of your costs are allowable. The next under financial management starts tying into really your cash management. Cash management is another really strict rules are in place really for the main purpose is trying to minimize the time between when the funds are given to the organization and how fast they're able to spend them or transfer them to a subrecipient. The federal government feels that entities need to be able to be efficient and be able to pass those down on a very timely basis. You're seeing obviously a little bit less of the advanced funding requests. There's still some out there. You know, most grants you see nowadays, of course, would be cost reimbursements, but oftentimes there's still some advanced funding. Same thing really applies there though, too. You don't want to be requesting the funds too far in advance. The federal government obviously has issues with certain of those, and there's a lot of different grants have different rules. I know there's some very, very complex rules that affect financial aid at higher education institutions. There's a lot of day rules that are in place with 3 days and 27 days and 30 days. A lot of day rules really just to really minimize the time that the funds are held at the organization. They need to be obviously given to the ultimate user or who's ever going to receive the funds on that basis. For reimbursement requests, obviously same thing. We want to make sure that those are, once the reimbursements are made, that they're actually payments on those requests are done within 30 days of the receipt, unless obviously there's issues relating to the ultimate recipient of those funds. And of course, the federal government always encourages the organizations to use any of their program and program-related income before they use their current funds. And of course, the tip we leave there is making sure you have procedures for cash management requirements, that you know how each of the grants work, to know which ones have certain day rules that you're able to follow, and making sure that all the day rules are followed. Because typically what happens, if either the auditors come in or an outside federal agency comes in to do a site review, they're going to be asking for drawdowns or disbursements of cash. They're going to be looking to see how fast those funds were actually put into the intended use. Next, we're going to get into the subject of actual internal control, and that's found under section 200.303. One thing that we'll mention here, that guidance on internal controls used to be found in the audit requirements under the circulars. Now it's moved into more of the administrative requirements, so it's important, and obviously non-financial entities have to have an effective system of internal controls. It's really in accordance with the COSO. Those COSO standards have been around a long time, and they have to be in accordance with those. There needs to be really prompt action anytime there's a non-compliance. You need to make sure that if there is non-compliance, that you're addressing those. And oftentimes in single audit situations, you do have to report the following year on whether or not there's non-compliance, if the corrective action was taken, and what is the status of that corrective action. One thing that was added in, it's in the news a lot more now, is making sure organizations are taking reasonable measures to safeguard protected personally identifiable information. You see so many security breaches that have occurred. A lot of organizations are very prone to those type of breaches. Of course, higher education institutions, hospitals, in that environment where you have a lot of data on individuals. A lot of that data is information that people would like to get their hands on, so having a good internal control system over that is obviously important in that area. A key tip there, of course, is making sure you're not only designing. It's important to design an effective internal control system, but it's equally important to be able to have a process to monitor that design of that control, to determine whether or not you're achieving the results you intended to have. It's good to have a good system, but if you're not really monitoring that system, you really can't tell if it's really being functioning effectively or not. So you need to have a system. Obviously, the system has to be designed and has to be monitored on a regular basis to really be truly effective. The next slide really just highlights and talks about some of the good examples of internal controls which you'd be trying to achieve. And really what the environment relates to is really, what is what is the tone at the top, as far as the board and management? How do they demonstrate a commitment to integrity and the ethical values that are necessary to have a proper general control system? So those are important. Obviously, the tone that is set at the top really just puts the system in place and gives it more credibility. If organization sees that management and the board are really committed to establishing a good internal control system. The second thing is looking at the education, making sure that there's communication, there's actual training on the grant requirements, so organizations know, people within the organization, the key program directors understand what the grant requirements are and how to establish what those internal controls over compliance would be. Next would be your risk assessment, identifying what risks to the achievement of program objectives. And that really ties in a lot we mentioned earlier about performance measurement grants, making sure that the objectives of the program are being achieved. So risk assessment there is very, very important. Segregation of duties, making sure that there's separating the authorization, the custody, and the record keeping. That's how to try to prevent or deter fraud by one person committing it. A lot of times, if you work in a small environment with small organizations, this is usually a struggle. Oftentimes the organization just doesn't have the available budget to be able to have a perfect segregation of duties. So in those circumstances, we usually recommend looking for some sort of compensating controls, whether it's involving a potential, maybe a board member or someone else being cross-trained in an area to be able to at least have a system of review in place where one person doesn't have the opportunity to be able to commit do multiple things within the organization and not be detected. The next thing is the authorization of transactions. Of course, that's very important when you're looking at allowable costs. Is there a review in place that an appropriate person is approving those transactions? The same person, for example, shouldn't be generating a transaction and also approving that same transaction. That's where really internal controls come into play, and it really ties into, of course, segregation of duties. Retention of records, making sure that there's documentation to substantiate transactions. I always say this too when we're looking at doing testing for allowable costs, for example. It may be a perfectly allowable cost, but if there's not records to substantiate it, it's really considered an unapproved or unallowable cost. So unsubstantiated costs. So it's important to keep records, whether they're electronic or not. I know a lot of organizations and institutions are getting away from paper records, but there needs to be some sort of record, electronic or not, that really relates to maintaining that system, keeping a system of maintaining that documentation. And then finally, the last one on here on this page is supervision and monitoring of those controls, making sure there's some sort of observation, making sure that someone's looking at the effectiveness of internal controls. I mentioned it doesn't do very well to design a great system of internal controls without doing the monitoring of those controls. So it's important to have a system of not only just designing the controls, but on a regular basis monitoring those controls and determining how effective those controls would be. A few more items of examples of internal controls. Having physical safeguards in place. Obviously, if you're an organization that has a lot of important supplies or large dollar amounts of supplies, having the necessary physical safeguards, whether it's cameras, locks, whatever kind of protective property you have to do to make sure that those items are kept secure. Because if they're received with federal funds, you're required to have some kind of a system to be sure you're safeguarding, physical safeguarding those controls. The next one would be a top-level review analysis. You hear a lot of KPIs with the key performance indicators, making sure you're using some sort of metrics to periodically check your operations and understand if they're working properly. And then finally, there's going to be IT controls, both in the general terms and the application controls. And they're really for the general controls. You want to be sure that, what is the security over your system? Who has the ability to access that system? Really, you have to ask yourself questions too. A lot of times it's just easier to give everybody access to internal control, to everything in the system, because it's just easier that way. instead of maintaining separate rules or for different individuals. So what you need to do as an organization is really ask yourself, who really needs access to those controls? That's the first question you need to ask. And then, make sure someone's actually reviewing that access. Is that access still necessary? Because oftentimes an individual changes their role within the organization, but that access doesn't change. And that would be an example, making sure that you're also following access logs to see who is gaining access to certain things. The other thing you're looking for, too, with access is, are you looking for any unusual access patterns? If you oftentimes see someone accessing your system at 2 in the morning, that could raise a red flag. What is going on? Why does someone need access to our system at 2 in the morning? They try to do that then because they feel that there's not as much monitoring going on, so you have to be sure that you're looking for that. The same thing, too, anytime there's a change in user access, or is that change being approved by somebody? Is someone accepting that change? And then, of course, making sure that the controls are over migration of coded or in production. So those type of things you want to look for, any type of change management. That's really the general controls. And then, of course, below that would be the application controls. Are there controls enforced that do edit checks, for example? If you're working with an organization or you're in an organization that gives out certain types of either financial aid or certain aids that are basically capped at a certain level based on an individual's income, do you have certain edit checks in place to be sure that there's not unauthorized approval of certain individuals to receive more funds than they would normally be eligible for? So do you have some kind of system in place, controls in place within your system to be able to monitor for that type of application controls? There's going to be some questions to get your CPE code. We are requesting for CPE credit. You do have to include these at the end of your presentation. The first key word is going to be the word federal. So when you submit your survey at the end, that will be the first word you have to include to be able to get your CPE credits. Once again, the word is federal. The next section, we'll start to talk more about some of the subpart B, the post-federal award requirements. One of the big changes, of course, the big areas would be in the procurement area. Procurement falls under several sections, actually. It starts in around 200.317, but it goes all the way to 200.326. There's some specific requirements as far as those procedures go. It requires, really any entity that contracts with other non-federal entities, there's certain performance requirements that have to be met. There's some specific language as well found in section 200.318. Really what the goal is try to avoid acquisition of unnecessary items, making sure that where there's possible to consolidate some procurements. Obviously, a lot of times it's more economical to do consolidation of procurements, and then also encourages entities that if there's situations where they could go into intergovernmental agreements, really cooperative purchasing, that would be encouraged as well. Also encourages, of course, first the use of federal surplus property before purchasing any new items. Trying to obviously make sure that awards are going to responsible contractors. If a contractor has never carried out this large of a contract, they may not be considered in that contract. Really maintaining records is not really a new requirement, but it's important to make sure you have those requirements, including any of the bid history, the rationale for selection of a contractor, because there are circumstances we'll note that you don't necessarily are required to take the lowest bid, but you do need to have a rationale for selection of that, oftentimes if it's not the lowest bid. And really, time and materials contracts are generally disallowed, but sometimes they're available if there's no other contract that's suitable. You'll see an appendix that contains some of the mandatory contract language further on. There's certain performance requirements that fall under procurement. Anytime you have large contracts, what I would consider large would be something over $150,000. that they have that falls under the simplified acquisition threshold. Oftentimes, you have to negotiate profit as a separate element of price where there's no price competition at all. And oftentimes, you need to do a cost analysis being performed as well. And really, you can't have unreasonable requirements. You can't limit the competition by putting some requirements that really only make the competition drastically eliminated. That will not be something that's allowable in the contracts themselves. As far as method of procurement, really Section 200-320 talks about the different methods. The first one is the small purchases. Really, they call them micro purchases. That would be purchases of supplies that are less than $3,000. Keep in mind, purchases of $2,000 or more are subject to Davis-Bacon, but they don't really require quotes to be received. But really, there should be some sort of an effort to be sure that you are distributing, not purchasing strictly from one provider, but you're also giving equal opportunity to other qualified suppliers. But those are your smallest purchases that don't have a lot of additional compliance requirements. The next step up would be considered small purchases that are found between $3,000 and $150. They do require quotes, so you do have to get quotes for those type purchases, but there's not required the additional pricing analysis. Where you get into larger contracts, the ones that are $150 and above, that's where you get into the sealed bids required for those purchases. They do require the public solicitation, and typically they have to be at least have 2 responsible bidders, and those bids would need to be opened publicly, and usually it's awarded based on the lowest bidder. There are some requirements on that as well, found in Section 200-320C. Competitive proposals are usually, as I mentioned, over projects over $150,000. They could be fixed price or cost reimbursement. Typically, you see these when you're dealing with architectural, engineering, professional contracts, and price isn't necessarily used. Instead, it's really awarded to the most qualified competitor. Then the compensations then become subject to the negotiation provisions. Sometimes you see non-competitive proposals where you just there's only one source out there. There's not really an opportunity. Maybe it's a very, very specialized industry, and there's only one source that's really feasible and available. Oftentimes, if it's an emergency situation, you're not really able to go out and do competitive bids. Obviously, if the roof is leaking, you need to fix it. That's not necessarily a circumstance where you're going out looking for competitive bids on a quick basis. Oftentimes, you do receive permission for non-competitive, but oftentimes that needs to be awarded by the federal agency. Some of these new procurement rules, keep in mind there is a 1-year grace period for implementing some of these requirements. The last section on the procurement mentions recovered materials. It really applies to state and states purchases greater than $10,000, and they're trying to achieve whether it's the highest percentage of recoverable materials. This area definitely is subject. You do see sometimes audit findings where this isn't really being followed. We do leave several final implementation tips and relate to procurement. They can be found in these different sections. One is making sure you understand the guidance. Keep in mind that the conflict of interest policy falls very close in hand with procurement. So those two kind of the procurement policies and conflict of interest really have to be read together to understand that. You need to educate your staff and your elected officials to understand what the policies are, the ones that are making the key decisions on procurement, making sure they understand the rules, making sure that everybody has read the procurement rules of the organization and their conflict of interest policies, and whether it's elected officials that act on behalf of the entity or the staff that are actually making the decisions. And then finally, make sure you have a template that incorporates all the elements. If you go to Appendix 2, you'll see those elements that are found under the contract. That brings us to cost principles, and I want to once again introduce Mark DeVries. Mark's going to talk both about the next section on cost principles, and he'll also finish up with some of the audit requirements for the uniform guidance.
All right. Hi, everybody. Out there in CD lands. My name's Mark, Director for Government Service here at Sikich, and I've been involved in public sector auditing and accounting for about 20 years now, and I quickly developed a passion for this industry right out of college. And I'm hoping that I'm very passionate about this, and I hope you are too, and I hope some of that passion is going to spill through this presentation today and inspire you all to implement these new principles, because really what we're trying to do is help you all avoid audit findings. Believe it or not, auditors hate them just as much as clients do. We don't get bonuses for the audit findings that we have. We want you to implement these effectively. And just to give you a little background information on how we put this presentation together, Ray and I went through all of the materials that we presented to you on slide 8, that useful information slide. And there are hundreds of pages of guidance there. We attempted to identify every single change that we saw in the guidance and summarize them here in this 2-hour presentation. And they're all here, and we don't have time to go through each one of them in gory detail, but they're all in here. So if you see something that may apply to your organization, we reference them so that you can go back to the guidance and look for those and research those questions that you might have. And also, further, one of the questions I get most from my clients as it pertains to implementing new standards is, what do you see other people in the world doing? Which is a fair question, because we come in contact with a lot of clients, and so a lot of clients look to us for suggestions for how to implement these standards, and that's why we put these implementation tips into the presentation today. This is what we see your peers doing out there in the world. And hopefully you'll take this and use this as a resource, take it back to your program managers, have them go through it, or you'll be able to view the presentation later on. Again, if there are people in the organization that you think may benefit from this, because we really want you to have 0 audit findings as it relates to this new guidance. So now I guess it's my job to keep you all awake for the next hour. I'm confident that I can do that because we're going to talk about cost principles. And I'm really excited about cost principles, and I hope you all are too. So let's get started, shall we? All right, so this first change isn't really a change. This question's been around for ever since I've started practicing back in 1994. And the question that I get a lot from clients is, can I charge administrative costs directly to a grant? Administrative costs are usually thought of as overhead costs and typically would be included in an indirect cost rate allocation. But the answer that I've always had was, yeah, if that time is spent directly related to the program objectives, then yes, it is allowable to charge to the grant. You can charge it directly to the grant. But now, if you do charge it directly to the grant, that you can include it in your indirect cost plan, because that would be double dipping, and there's no double dipping not allowed. So you can't put them in both, but you can definitely charge them directly, provided that it's directly related to the activities of the grant. Now, speaking of indirect costs, this is one of the areas that are the biggest change, and the reason the OMB made changes in this area is because they noticed that some organizations, or a lot of organizations really, had multiple indirect cost rates, depending on who they're reporting back to. And so what they've done with this new guidance is now established one uniform indirect cost rate that will apply to all of your federal programs. And some of you have negotiated cost rates that you're already using, and some of you may not. And if you don't, you may say, Mark, well, I don't have a negotiated rate. What do I do? And, well, my answer to that would be, well, you don't really have to do anything if you don't want to. You can elect to use the minimum rate, 10% of your total modified direct costs. You can use that for as long as you want. Or you can negotiate a cost rate. And the next question would be, well, Mark, how do I negotiate an indirect cost rate? And then my answer would be, well, that really depends on the type of entity that you have. And again, we don't have all the time to go through all the different nuances, but here's the guidance. It's Appendix 3 through 8, or 3 through 7 rather, the uniform guidance, and it really breaks down the types of entities into 3 different types. There are institutes of higher education, there are nonprofits, and then the third group is states, local governments, and Indian tribes. And a little bit different for each one, but here's where you can find, depending on the organization that you have, here's where you can find that guidance. If you desire to negotiate the indirect cost rate, you know, you may want to do that if you think that your indirect costs exceed 10%. It may be beneficial to you to negotiate an indirect cost rate. Now, for those of you that already have a negotiated cost rate, do you need to do something? And the answer is yes, you still need to do something. You can apply for a one-time 4-year extension of your current rate. If you don't, then you can either renegotiate your current rate or you can use the diminished rate of 10%. Okay, here's another big one. Compensation in personal services. Now, the federal government has finally dragged themselves into the golden age of wireless here. And we're now has finally realized that some of these standards are burdensome and even obsolete, outdated. And so, and also they've recognized that a lot of the findings that they're seeing as it relates to personal services are related to the documentation, and really the one that I see the most is the semi-annual certifications, which, you know, I mean, nobody likes to do these things, and I issue a lot of findings about these, and everybody thinks they're stupid, and they are kind of stupid, because if it weren't for the grant, this person wouldn't even exist, right? And you can see that going back into your HR file. So what is the point of these semi-annual certifications? You know, the thing is that the fact is that this person doesn't only exist to serve this grant, and so really there is no point, and to write them up for something like this is really kind of ridiculous. And really what we want to see is the focus on fraud and waste areas instead of documentation like you have in your semi-annual certifications or someone did a timesheet or something like that. So OMB has finally realized that, and they no longer require semi-annual certifications, and they no longer require signed timesheets for non-exempt employees or exempt employees that spend less than 100% of the time on a single federal program. So no more paper if you don't want it. The new standards require that your records are supported by a system of internal controls. We're going completely internal control based now. They reasonably reflect the total activity for which the employee is compensated, and that holds true for your exempt employees as well. And both grant-related and non-grant-related time has to be accounted for. I think right now I want to say something about that. Some of you may be saying, well, I have an exception-based payroll system. How would I implement that for my exempt employees? And one of the things that I see happening out there in the world is that some employers have opted to set up exception codes for their grant-related time so that their exempt employees can enter their grant-related time as an exception code. And you may say, well, that sounds like a lot of work, but aren't you doing a lot of work already with all this paper shuffling? And really, that's HR's problem. So that's one thing that you can do. But at any rate, that gives you, if you do decide to implement that way, really that gives you one system that's got all this information. And really, if you can further that and give your auditors read-only access into your system, so then you don't have to pull a bunch of paper for them at the end of the year. They can go in to your system and see that without them having to interrupt your day-to-day business. Okay, so incorporated into the official records of the non-federal entity, the standards require that you comply with the established policies of the non-federal entity. There again is your established policies. Now I'm assuming that all of you out there have written policies that pertains to payroll. Encompass both federally assisted and other activities that have gone through that already. Two things that we want to point out here are budget estimates do not qualify as support, but you can use them on an interim basis. If you do use budget estimates as a charge on an interim basis, you are required to settle up at the end of the year when you do your, when you do your closeout, your grant closeout, and so that whatever cost you're charging is reflect the actual time spent. I don't see this happening very often out there in the world, but because you are required to reflect accurate time, the actual time. Why not just do that on a consistent basis? Also, salaries used in new matching requirements are subject to the same documentation rules or internal control rules. Again, that's always existed, but the point here is that all of this is now moves away from that paper documentation, and you can implement this into your internal control system. Now, maybe you're one of these people that your auditors have beat you up now for the past 25 years, and they pummeled you into submissions, and now all of a sudden the standards are changing. You may ask, do I really need to change everything now? And the answer to that is no, you don't have to. If the old rules are working for you, you can keep them. You can hold on to your paper if you want. It's provided that you comply with the old requirements of A21, A7, A122 for documentation of personal services. You don't have to change anything if you don't want to. But it is important that you do change for those employees who spend all or a portion of their time on federally funded programs. The decision to eliminate paper should include a system of verifiable approvals for all employees' times that is both charged to grants and not charged to grants. So really what we're looking for there in the system of internal controls is approvals and segregation of duties. So you're still going to have to see in the system that somebody has approved that time and that the person approving it is not the same person that's working. Okay. Here are some other compensation principles, and most of these are going to apply to institutions of higher education. I know that we've got some of you out there in the audience today, and so I just wanted to mention them to you. We're not going to go through these in gory detail, but here they are. Standards that deal with incidental activities, the salary basis consulting, extra service pay, periods outside the academic year, part-time faculty, and sabbatical leave. Those all apply to institutes of higher education, and here are the different sections where you can find that. If these apply to you, I would encourage you to go out there and read the standards and implement them. Also, tuition benefits and on-behalf payments and benefits, those apply only to higher education as well. And finally, here's one that applies to everybody. If you've got an employee that has an automobile that you give them, or a company car, I guess, they can't charge gasoline for going to pick up their kids for from soccer practice or something like that. That is not an allowable cost. And really, this is logical, stands to reason. But again, there must have been some instances of this happening out there in the world, and now the OMB has clarified this in the standards. Okay. Advertising and public relations. This is new guidance. There are new allowable costs in the guidance for advertising. First one, recruitment of personnel for performance of a federal award. Examples of recruiting costs would be some would be advertising for positions, outsourced recruiting costs if you're using outsourcing an agency to recruit for you, that's an allowable cost. Aptitude testing, if you're testing potential employees to see if they're apt for the position, that's an allowable cost as well. Travel for the potential employee to come and interview with you, it's an allowable cost. And finally, relocation expenses. Moving on, procurement of goods and services for federal awards. In other words, if you're advertising your procurement, that is an allowable cost as well. And public program outreach to meet requirements of the federal award are allowable to the extent that they are not promoting your entity. You can't advertise your entity and then at the end of the advertisement say, oh, by the way, you can start a program. But you can advertise the federal program and then put a little blurb about your entity. So just use your discretion there. Public relations for communicating with public for specific activities and accomplishments of the federal award is also, and that really goes with kind of ringing your own bell or tooting your own horn as to what we've accomplished with this program, and the federal government wants to see that. Unallowable costs on promotional items such as gifts and souvenirs. I know that sometimes you go to conferences and with a bag and you'll stuff your bag full of these little trinkets that exhibit to you. Those are the types of things that we're talking about. Those little fans or thumb drives that fall apart second time that you use them. Those are the types of things that we're talking about here. Those are not allowed. Oh, speaking of conferences, here we've got some new guidance on conferences. Okay. Is this really new guidance? Oh, Section 200.432 clarifies previous guidance to include only that conferences that are necessary and reasonable for successful performance of the federal award is allowable. So the first part was already there. The meeting, seminar, and symposium, whose primary purpose is to disseminate technical information, that already existed. The second part did not exist, but now does exist. Because, again, we must have had some people out there who were abusing this. Oh, here's something that's new. The federal government is finally recognizing that demographic trends in the workforce and trying to make it less expensive for working spouses to identify dependent care when traveling to conferences. So they will now allow you to charge to federal grants the cost of identifying but not providing locally available dependent care for attendees. So you can't charge the cost of providing dependent care, but you can charge the cost of identifying where that dependent care is. Oh, okay. Speak louder. I'm being told to speak louder. This is my microphone. Okay. All right. Other changes in the guidance. Collection of improper payments is now allowable. This is a new change. Examples of improper payments would be payments made by a non-federal entity or improper claims or erroneous payments. If the recovery includes legal action, those types of charges are now allowed. Contingency provisions. Now this is, again, existing guidance that's been clarified. Contingency costs are permissible to the extent that they improve the precision of the cost estimate. They are not permissible to the extent that charges for contingency reserve for the occurrence of events that cannot be foretold with certainty are allowable. So what's the difference between those two? Contingency costs related to possible events, the outcome of which is not precisely determinable and that experience shows will likely result in additional costs, are the type of costs that will be allowable and charged to federal grants. Budgeting contingency for events that cannot be foretold is not allowable. So that's the difference between those two. Depreciation, again, this is not a new standard, but it has changed. The new part is that all depreciation can only be charged in accordance with GAAP, and that the cost of donated equipment is the fair market value at the time of donation, which is also GAAP. Oh, here's an interesting one. Entertainment costs. Now, entertainment costs were formerly disallowed, but now they are allowed. They have to be programmatic in purpose and are authorized by the federal agency. What this means, you can't go out and party like rock stars and charge it to your grant unless you're a Secret Service agent. But I don't know that we've got any Secret Service agents out there today. Just know that now you can charge entertainment costs. Also, one other thing to add there is that alcohol is still unallowed. So alcohol does not fall under entertainment costs. Here's another new one. Exchange rates. This is not previously addressed as a cost. It is now. Cost increases for fluctuations in exchange rates are allowable costs. They have to be subject to prior federal approval, which I'm not quite sure how you budget for that. But anyway, it can be a part of your allowable costs, providing it's already been approved. And also providing that any gains that you experience that would offset those losses are also considered prior to your grant closeout. General government expenses. This is also new. Indian tribes and the Council of Government now may charge up to 50% of CEO and CEO staff salaries and expenses directly attributable to grant management in their indirect cost plan without documentation. How is that different from the first slide on direct costs that we just showed you? Well, this deals with, first of all, it deals with indirect costs. Secondly, you do not have to support this charge, this indirect cost charge. And third, the charge is for grant management. Grant management means grant management of overall grants, not related to any one specific grant. If it is related to one specific grant, then it can be included as a direct charge. Okay, materials and supplies costs. Again, this is not a new standard. The change in the standard is now that the computing devices are not required to be solely dedicated to the federal award. So what the guidance used to say is that all supplies, materials had to pertain to federal awards. And now they're making a concession for computerized devices only because they realize that sometimes you got to check email, and those emails may not be pertain to a federal award. So, and other things related to it. So that's new. Memberships and subscriptions that's some clarifying guidance. Memberships and entities whose primary purpose is lobbying is not allowable. And again, this is nothing new. Lobbying has never been allowed to be charged to federal grants. But I guess we've had some people who are trying to abuse this, and really, this is all keeps in the original spirit of the guidance, and now it's just been clarified because I think there's been some abuse out there. Publications and printing. The cost of publication results of research are now available, provided that those results are available prior to closeout of the grant. And finally, recruiting costs, which we covered a little bit already, but again, this is a new requirement. The cost of short-term travel visas are allowable to the extent that they are necessary and reasonable and directly related to the grant. Okay. Relocation costs. Relocation costs have always been a part of guidance. This guidance has been clarified so that continuing cost of ownership of a vacant home is allowable for up to 6 months following vacancy. That used to be an indefinite period of time, and now that time has been limited to 6 months. Rental costs. This is also clarified. It defines family for less than arm's length transactions, and also excludes rental of property owned by persons affiliated with a non-federal entity, including commercial and residential real estate. So if you got some people, I guess, said, oh, I've got this office at home, I'm going to start charging the program rent for my home office. And now that is now specifically disallowed in the guidance. And finally, travel costs. This is a new standard. Temporary dependent care cost above and beyond regular dependent care costs that directly results from travel is allowable. Okay. So what does that mean? That means that if there are dependent care costs that exceed what you would normally pay, the difference between what you would normally pay and what you're paying because you're traveling is an allowable cost. Just that difference, not the entire cost. And then, of course, there are certain provisions. So if you are charging this cost, you want to look at this code section. Okay. That was a lot about cost principles. But I think we've covered all the cost changes in the cost principles now. Now, program managers should review the types of costs currently charged in their grants and review guides. They're the ones who are most familiar with the types of charges that pertain to their grants. They should be going back and looking at these cost sections, and they're all included in this presentation. So really, this could be a resource for your program managers to go back, see which cost principles have changed, go back into the guidance and see how that's changed, and then also communicate that to their staff, because the staffs are they're the ones out there incurring this cost, so they need to know about these changes as well. Educating your staff is a good internal control method. Any questions that arise from the review can be directed to the federal or pass-through agency for clarification. and preferably that should be written. Yeah, I think the pass-through agency would, if you have a pass-through agency, that's probably where you want to start. I don't know if any of you have ever tried to get an answer from a federal agency before, but if you get one, it takes some serious time, and probably several times. And finally, you know, for some of you, this guidance is going to be effective going forward for this calendar year. Starting in 2015, December 31st, 2015 year ends, this is going to be effective. So for some of you, this is already effective. For you school districts and so forth that have June 30 year ends, this doesn't start for you until July 1st, 2015. But if you're one of those calendar year ends and you haven't implemented yet, you can, don't panic. There's still plenty of time to implement these. You've incurred unallowable costs. If you've been listening to this and something that I've mentioned to you is now unallowable, don't panic. You can go back and fix it before you close out your grant. Most auditors will not ding you for that if you come across, provided that you've taken corrective action and that you've identified that yourself. So, you know, I don't think that if you've not been doing these things or if you have been doing them wrong, you can still, there is still time to fix that. I think the important ones are going to be your indirect cost rates first. And also the subrecipient monitoring that Ray was talking about earlier. If you haven't addressed that yet, that's going to be a deadline. You should be doing that. And really, that's all stuff that you should have been doing already. And really, it's just included now in the new guidance. And now, we're going to go to audit requirements. We're moving out of cost circulars into audit requirements. So the expenditure threshold for audits has changed under the new guidance. Under the old guidance, if you expended more than $500,000 in federal funds, you were subject to single audit. Under the new uniform guidance, that's now changed to $750,000. If you are one of those entities that falls in between there and you're uncertain which guidance is going to apply to you, here's the rule. Non-federal entities beginning on or after the effective, if your fiscal year begins before 12/26/14, you're subject to the old rules, A133. If your fiscal year is beginning after that, you are subject to the new uniform guidance of $750,000. So those of you planning for single audits either in your budget or whether you're blocking off time to deal with auditors, this will be important for you. So non-federal agencies' responsibility for contractor compliance. Of course, we already explained to you that you are responsible for your subrecipient's compliance with the single audit requirements. But what about contractors? Typically, contractors are not subject to single audit requirements. However, this new uniform guidance now has clarified that contractors are responsible for following procurement guidance. And the person that's responsible for making sure your contractors are following those guidelines are the audit team. So if you are contracting out, you've probably followed all the correct procurement procedures. But if your contractor is subcontracting out any of that work, that process also has to be guided by this new guidance. And you are responsible for making sure that happens. So part of what you can do is get involved in this contracting process. Have those records available that the subcontractors have done, the subcontractors have been contracted with according to the procurement guidelines that apply to them. If you're out there and you're an auditor, you're out there listening to this, for a major program that includes contractor relationships, the scope of our audits now have to include determining whether contractor transactions were in compliance with the requirements. So as auditors, we are now responsible for making sure that the people who are contracting and subcontracting are also complying with those procurement requirements. So, of course, the tip for that would be that your pass-through agencies and your contractors should understand the procurement requirements and educate subrecipients on the requirements. One way to do this is just to include those requirements in your contracts. And also build subrecipient monitoring processes into your process. Okay. What if you failed to have a single audit and you were required to have one? Well, that's bad. And there are additional sanctions that the federal government can now take against you. We've highlighted these in red today. What existed previously was that they were able to temporarily withhold cash payments, disallow overhead costs, and suspend or terminate the federal award. But now they can also disallow the cost of the entire activity that's not in compliance. They can also initiate suspension and debarment procedures, which means that you can't receive any federal awards. Further, they can withhold any further federal awards for the project or program and take any other remedies that may be legally available against them. So really they can do anything that's within the scope of the law, including up to suing you if need be. But they're going to start probably like this by withholding your payments. So if you're, the point of this is if you're unsure about whether single audit requirements apply to you, if you're on the fence of where your threshold is or which expenditures are going to be included in that calculation, you should be talking to your auditors right now about that so that you don't miss on a single audit. Okay, we have another CPE code for you now that you'll need to record. And that code is compliance. We talk a lot about compliance. Okay, changes in audit costs. So there's been some additional regulations that pertain to audit costs. Some audit costs can be charged to federal programs. If you are an auditor that does not have a single audit, can you charge the cost of your financial audit to your indirect cost rate? Is that an allowable charge? And the answer is yes. Now, when would that typically happen? Well, you may have federal awards and you're under the threshold for a single audit, so you don't have one, but you still charge the cost of your financial audit. So that's one specific incident. The other is that you may not have a single audit a year. You may fall in and out of the expenditure requirement, and maybe your cost, your indirect cost plan lags behind for 2 years. Those are instances where you can still charge the cost of your financial audit to your indirect cost plan, even if you don't have a single audit done. The cost of agreed upon procedures engagements that monitor subrecipients and that determine subrecipient compliance with matching level of effort and earmarking are no longer allowable. They used to be allowable, but they're not. And why they're picking on that specific compliance requirement, I don't know, but they're not allowed. Changes to your CFA, Schedule of Expenditures of Federal Awards. Your CFA now must include a total for clusters of programs, and that includes both for pass-through entities and direct awards. So if you've got a pass-through entity, you've got to combine it with your direct award to come up with the total for the cluster. It's going to make your presentation a little bit interesting. Also for loan or loan guarantee programs, identifying the notes to see the balances that are outstanding at the end of the audit period. A lot of people do this already. It wasn't a requirement before, but now it is. So this is in addition to including the total federal awards expended for loan and loan guarantee programs. If your entity elected to use a 10% de minimis indirect cost rate, what we were discussing previously, this must be disclosed in the notes to the CFA. And of course, your implementation tip here is to build the new CFA requirements into your CFA. And if you're unsure about how to do that, please talk to your audit firm and they can assist you with that. Audit findings and follow-up. Summary of the prior year audit findings. Now must report on status of findings related to the financial statements, which are required to be reported in accordance with generally accepted government auditing standards. Okay. What this means is that previously you were not required to report on prior year, on status of prior year findings for your financial findings, internal control of financial reporting or compliance that didn't pertain to the A133 or federal compliance requirements. Was not required to be in status of prior year findings, and now it is. When audit findings were not corrected or only partially corrected, the summary schedule must now describe the reasons for the findings recurrence. Why haven't you fixed this yet? The federal government wants to know. Is probably what you told them in your prior audit was how it was going to be fixed in your responses, and who is responsible for fixing it. And if it hasn't been fixed, now we want to know why it hasn't been fixed. Okay, changes in report submission. In other words, reporting to the Federal Clearinghouse and submitting your data collection form. Indian tribes may now opt out of the data collection form submission. Instead, they're responsible for making copies of the reporting packages available for public inspection. This only applies to Indian tribes, but they may include confidential business information that would be redacted under FOIA, which is not included for other entities. Confidential business information should not show up anywhere in your public reports. Uniform guidance eliminates the requirement for a subrecipient to submit its reporting package to the pass-through agency when there are findings related to grants passed through the agency, or when there are no findings. The requirement to communicate with the pass-through agency that an audit was conducted in accordance with the uniform guidance and there were no findings. If you don't have findings, you don't have to submit a pass to the pass-through agency. You still have to report to the Federal Audit Bureau. And again, you can't include any personally identifiable information anywhere in your report. Okay, cognizant agency requirements. If there are any of you out there who are a cognizant agency, these will apply to you. Non-federal entities spending more than $50 million in federal assistance will be designated a cognizant agency. Cognizant agencies will incorporate with OMB to lead a project that evaluates audit quality. Audit quality evaluation projects will occur every 6 years starting in 2018. The community of independent auditors will be advised of any noteworthy or factual trends related to single audit quality. Significant problems will be reported to state licensing agencies. And people, I think this is great because we see a lot of substandard audits out there, a lot of substandard single audits. And it's very frustrating when some of us are doing the work that's required of reporting properly and others aren't. So this is great for us. Okay, these more pertain to auditors than auditees. Major program determination AB threshold, or what qualifies as a Type A program versus a Type B program, now increases from $300,000 to $750,000, which is also the threshold for single audits. In the new guidance, only high-risk audit findings will cause a high-risk Type A program, whereas in the old guidance, any type of audit finding will trigger a high-risk A. And so those high-risk audit findings are ones that resulted in a modified opinion, that reported material weaknesses in internal control, that reported known or likely question costs greater than 5% of the total program expense. Type B program risk assessments have changed. The type program risk assessments on Type B programs have been identified up to at least a quarter of the number of low-risk Type A's. It used to be half, now it's a quarter. The new guidance reduces the audit burden for approximately 5,000 entities nationally, while still maintaining audit coverage of over 99%. I think Ray mentioned that a little bit earlier as well. This is just a matrix of the Type A and B thresholds, and if you're less than or equal to 100 million. Your type AB threshold would be 750,000 or 0.03 of the federal awards expended. If you're greater than 100 million, less than 10 billion, then your type A threshold starts at 3 million or 0.003 of federal awards expended. And if you are greater than 10 billion, your type A threshold is 30 million or 0.015 of federal awards expended. Audit coverage. This is the amount of coverage that auditors have to get. Your total federal expense, your federal awards expended, used to be for high risk oddities 50%, it's now 40%. And for low risk oddities used to be 25%, has now been reduced to 20%. No longer can you use the deviation from the use of risk criteria for first year audits. Now you have to do a risk assessment just like you always used to do for continuing audits. And also, if an auditee is determined, if there is substantial doubt about their ability to continue as a going concern, you can call that a low risk auditee. Okay, finally, just a few words about the new compliance supplement. The 2015 compliance supplement has been drafted, and parts of it were available to you for comment through the AICPA. The AICPA had all of it, we're releasing parts of it to interested parties for comment. That comment period has been closed now, and now the compliance supplement is back in review process and expected to be released in April. Here's what we know about the new compliance supplement so far. All the RF programs are now going away. Davis-Bacon has been eliminated from the compliance requirements, although you may see it pop up in your special testing provisions from time to time. So it might not go completely away, but you're not going to have the Davis-Bacon requirement. Real property acquisition and relocation assistance is going away permanently. That's completely going bye-bye. And new Part 3.2 will be used by auditors to audit programs subject to the new uniform guidance. So there's going to be two parts. One will pertain to the old guidance. That's going to be 3.1. And 3.2 will pertain to the new guidance. Two sections in this new compliance supplement. Okay, so before we get to questions, I'm going to just go through this first slide in the appendix. What we've done here at the end of the presentation is summarized all the implementation tips for you so that you don't have to go back digging through 60 slides to find the implementation tips. They're all summarized here at the end of the presentation, but this first one tells you how to do a successful implementation. And really, understanding the guidance, reading the guidance is the first thing that you need to do in order to have a successful implementation. Develop your plan to implement. You can use these implementation tips to develop your implementation plan. Here are the specific policies and procedures that you need to have written. And we've gone through this in various areas, but now we've summarized them here at the end of the presentation. Here, these are the areas where you need to have written policies. Conflict of interest policy, procurement policy needs to be written. Now, many of you already have a written procurement policy, but there is specific language now in the new guidance that needs to be included in your procurement policy, and that's located in Appendix 2 of the new guidance. So make sure that you're reading through that and that you're including the required language in your procurement policy. Payments, this pertains to payments that you make, and really is part of the cash management requirement. And the reason why they want written procedures for payments is that they want to know that you are turning those payments around, especially in instances where you receive advances, that you have policies in place to turn that around as quickly as possible, and you're not letting that cash sit there in your bank account earning interest when it really should be going out and being spent. And finally, you must have written policies and procedures for determination of allowable costs. And it doesn't have to be, within
it's a good thing for you to have them certify on maybe an annual basis that they've read these policies and that they understand them and that they're going to comply with them. One thing about the conflict of interest policy, it's not required that the policy includes conflicts of interest between program managers and participants. But I think that's a good idea to include that, because sometimes you may have a program manager who is, or maybe somebody determining eligibility in a program that may be related in some way to a person that's applying for that assistance. And so, so there's a conflict of interest there inherently, and you should probably have some kind of policy that addresses that. A good idea would just to be include that in the conflict of interest policy that is now required. Okay, I think we got a few questions that we're going to go through.
We might have time to answer all the questions, but what we'd like to do is go through them. We'll try to get to all the questions either in an email or get contact information back. We do want to go over some of them, though, once we can do in our time we have left. One of the questions I got, if we can go back to, was they have a question of what do we do when we're a small organization and we have a segregation of duties issues of finding? How do we address that one finding? Really, what I recommend the smaller entities do is they need to have some kind of a system where there's some kind of compensating controls. And I'll give you a good example of that. We had to work with a small entity that didn't have a good segregation of duties, where there wasn't someone necessarily reviewing the bank reconciliations on a monthly basis, because they only really had a preparer to do them. And what I recommended to them was, why don't you have a board member randomly check the board bank reconciliation, say 2 or 3 times, maybe 4 times a year, and really, if it's on an unannounced basis, because you don't want to burden your board members too much, but if it's on an unannounced basis, that person who's necessarily, in charge of the bank recs, they're going to do a good job, because they don't know what month that person could be coming in. So having a system like that where you can put in a compensating control, where you have someone that has the opportunity to review something, sometimes that works as well, because a lot of times your staff, as mentioned in the question, your staff is small. You don't necessarily have a second person to do it. You may often have a board member who could come in a few times a year unannounced and be able to do that. And that would be an example of a compensating control. I have another question that came in on are food, drink expenses during a meeting allowable? For example, coffee, donuts, sandwiches during a lunch meeting. Those things would be allowable if it pertains to the actual federal grant program. Keep in mind, as Mark mentioned earlier, it cannot include alcohol, but if it's just food, beverage, items like that, that would be something, long as it's part of the meeting and you're discussing the program. It isn't a pure administrative meeting where you're not really discussing that federal program. See another question. I think they answered a couple questions.
I'll get the negotiated indirect cost rate. If you have a negotiated indirect cost rate that is higher than the grant allows, I think that's going to depend on who that grant is with. If it's with your cognizant agency, then you may be talking to them about whether or not you're allowed to use that negotiated cost rate. If it's not, if you have not negotiated that cost rate with your cognizant agency, it applies to another agency that's not your cognizant agency, then that indirect cost rate that you've negotiated is going to apply. The whole idea behind this negotiated cost rate is that it applies to all grants, all programs, no matter which agency it comes from.
I had a question on the Type A threshold too. Because I know there's a lot of higher education institutions that are probably listening in on that issue with the Type A program. One thing you have to keep in mind, because it looks like if it's over a certain dollar amount, you wouldn't have to do that program. But one of the rules for higher education institutions are things that are part of a program cluster that involve loans. For example, loans are something with continual compliance requirements, the federal direct loans, that loans have to be subtracted, or that whole cluster has to be subtracted out. So say you have over $20 million or $30 million of federal funds, you actually have to subtract out the portion that's the student financial aid cluster, and then from there you would get to a smaller amount, and that's where it's going to give you that type A threshold that may be at $750,000 versus a larger number. That question gets asked a lot. There was actually clarification a few years ago about that, because there was some misinterpretation. The fact that we saw other audit firms actually applying the 3% to the total federal awards, and the total federal awards could have been $40–50 million. But once you back out, most higher education institutions find that their federal funds are usually between 80 to 90% part of the student financial aid. If you back out that as part of what it has continual compliance requirements as part of a direct loan, and the federal direct loan as part of the student financial aid cluster, you are required to back that out.
All right, I have another question. Do you know the procedures for applying for an extension of our indirect cost rate? And the answer to that is yes. You will talk to your cognizant agency about extending that. Again, that's a one-time extension for up to 4 years, and you would need to contact your cognizant agency for that.
I saw a question on a grant. The question was, if you received a grant, based on what time of the period of the grant is, you have to determine whether or not the funds are within that grant. I think the question really relates to if you receive a grant notification. That grant notification does not attribute to an expenditure of the grant. For example, if you expended a certain number of funds, a single audit is always based on expenditure of funds. So if you were awarded a federal grant but you haven't started the expenditures of that grant, that would not fall under the single audit threshold to be able to determine whether or not you have a single audit. So for example, if you had federal funds of $500,000 and you're now going to be under the new threshold of $750,000, but you were awarded a larger grant in the future, that would not subject you to single audit until you start expending on the grant. The year that you begin expending on that grant is when it's going to trigger the need or necessity to have a single audit.
Okay, next question. If we have a construction vendor contract and that vendor then subcontracts, are we still responsible for the vendor subcontractor compliance? And the answer to that is yes. You are responsible for compliance of your contractor's subcontracting. And you have to make sure they're following the procurement requirements of the new single audit guidance. And your auditor is responsible for making sure that you have complied with that provision as well. So they're going to be looking for you to be monitoring your main contractor, subcontractor compliance.
The next question, we have a grant that expired 9/30/14 and expended $300,000 in current fiscal year. We just yesterday were awarded a new grant for $2.3 million. How do we determine whether or not we are subject to single audit, specifically the $500,000 threshold or $750,000? Keep in mind the $750,000 threshold is not effective until years ending on or after December 31st of 15. So if you were a fiscal year, say you're a June 30 situation, you would not be applying the 750 threshold till then. But really what the question I think is geared towards is they were awarded a $2.3 million grant. So it's going to depend on your fiscal years, how much you expend in those fiscal years. So if the fiscal year ended 6/30/16, you're spending over $750,000 on that new $2.3 million grant, then you would be subject to single audit. However, if in 2015 you spend $490,000, you're still subject to the $500,000, you'd be under it, and in the following year you only spend $700,000 for 16, you'd still be under the single audit threshold, so you would not have a single audit.
Okay, if a recipient or contractor does not have a negotiated indirect cost rate, what is the limit for indirect expenses, if any? And the answer to that is, if you don't have a negotiated rate, you use the de minimis rate of 10% of your total direct costs. Okay, we're gonna show the last CPE slide. I think we had a question on what was the one before this. So the word before this last one was compliance, and now I'm gonna skip all the way to the end. Oops, sorry about that. The last word is procurement.
Okay, I think we actually have some NCAA fans here. We have a question saying, do we think Michigan State will be able to beat Georgia in the NCAA polls? And I don't think we ever mentioned that that gambling is not allowable on your costs, but as far as opinion goes, I think I had Michigan State in my poll.
And unfortunately, I am from Michigan, but no, I don't think they're going to beat Georgia. I hate to say that. But they didn't look too good against Wisconsin. All right.
Okay, I thank you very much for all those. If there's any other questions that you have later, we do appreciate your time this past couple hours going through that. As we mentioned earlier, we weren't able to cover everything in the guidance for uniform guidance. There's a lot of hundreds and hundreds of pages. What we try to do, as mentioned, we tried to go through which we thought were some of the key issues, and keep in mind that really what this did is it really gave some separation. The first part of the presentation was more geared towards the administrative requirements. Then Mark touched on, of course, a lot of the cost principles, and of course, the audit requirements as well. There's really three things that fall under. What they did, as I mentioned too, that website that I mentioned earlier in my presentation is really a good crosswalk to go through that. You're able to look at the various different what was the old standard, what's the new standard, and they're side by side. I think that does a good comparison. Keep in mind, though, a lot of times there's not much difference, so you have to look really close at a few of them. I know that a lot of the changes were very, very subtle changes. If I were going to point anything out, is I think the main things, kind of like the biggest takeaways of today would be making sure that your conflict of interest policies are up to date. Make sure that people understand those, everybody within your organization, whether it's the CEO, the president, whether or not it's the program directors, even the people in finance need to be aware of what the conflict of interests are. I think another big takeaway, of course, would be the new rules with procurement. They're really strict on their procurement rules, and they really tie in, as I mentioned earlier, they tie into the conflict of interest. The procurement conflict of interest both really tie in together a lot. So that's another big takeaway. And then under the cost principles, one of the things on recording personal services, there are the services that people are charging against the grants. As Mark mentioned, what the uniform guidance does is it really gives you an opportunity to use what you always did use before. If you did your time studies and things like that, you're still able to keep using those. Or, as mentioned, there's ways that you don't necessarily have to go back and do those. A lot of individuals and organizations we work with struggle with all the paperwork for a lot of those time studies and keeping all those payroll records. But making sure you have a system in place, making sure internal controls are really strong, because really, as I mentioned, a lot of this new guidance is geared towards the more performance measurement. How well are you carrying out your programs? Are you achieving your goals? and making sure that your goals of your program are being achieved. It's not necessarily, as in before, is really monitoring the cost as much as it is really achieving your results of your programs, or your programs being conducted, and achieving the results that you're supposed to achieve within the grant. So thank you very much for your time. We tried to get to most of the questions we could. If there's any questions that come up later, if you make sure we have your contact information, either Mark or I will reach out. Any of the questions, it may take a little more research. We'll make sure we do that as well and get back to you. And once again, thank you for your time. I appreciate taking the time out of your day to learn about some of the OMB changes. Feel free to reach out to us later as well. You might think of a question a month from now or during your implementation. If you have any questions of that, we would be glad to, Mark or myself, glad to help you with. And as I said, good luck with your, if you're in the middle of your fiscal year or you're getting near the end of your fiscal year, good luck. And any questions that come up, please feel free to reach out to us. We appreciate taking the time, and we're happy to help anytime we can. Thank you very much.